So, what are cash dividends? A cash dividend is a payment made by a company to its shareholders as a distribution of its profits. For example, if a company earns $1 million in profits, its board of directors may decide to share some of those profits with shareholders in the form of a cash dividend. Let's say a company's board declares a dividend of $1 per share. This means every shareholder will receive $1 for each share they own. So if you own 100 shares, you'll get a cash payment of $100. The company is essentially cutting you a check from its profits as a thank you for being a shareholder. Now let's talk about how cash dividends work. Typically, companies pay out cash dividends on a regular basis. It could be monthly, quarterly, or even annually. But sometimes a company might surprise its shareholders with a special one-time only payout, like after winning a legal settlement. Cash dividends are often a sign of a well-established company with stable cash flow. They've already gone through the growth stage and are now in the business of rewarding their loyal shareholders. It's like a thank you for believing in their success. But wait, how do companies decide when to give out these cash dividends? Well, it's all in their hands. Each company sets its own dividend policy and periodically evaluates if a dividend cut or an increase is appropriate. So when a company decides to announce a cash dividend, they do it on what's called the declaration date. This is when they reveal how much money they'll be paying per share. Now, once the declaration is out, the company sets a record date. This is the date when they determine which shareholders are eligible to receive the cash dividend. So, if you're on the record, you're in for a treat. But hold on, there's one more important date to remember. It's called the ex-dividend date, and it's usually 2 business days before the record date. If you're a smart investor and you buy shares before this ex-dividend date, congratulations. You're entitled to that sweet cash dividend. Now let's talk about the nitty-gritty of accounting for cash dividends. When a company declares a dividend, they debit their retained earnings and credit a liability account called dividend payable. On the payment date, they reverse the dividend payable with a debit entry and credit their cash account for the cash outflow. It's important to note that cash dividends don't affect a company's income statement directly. However, they do reduce the company's shareholders' equity and cash balance by the same amount. So companies must report cash dividends as payments in the financing activity section of their cash flow statement. Let's talk about what types of companies pay dividends. Companies that pay dividends are usually well-established and enjoy stable cash flows. They're beyond the growth stage and are in a place where they can comfortably share their profits with their loyal stockholders. These include utilities, consumer staples, telecoms, and industrial companies. Well, fast-growing companies often reinvest their earnings back into their operations, like building factories or expanding their teams. They need those funds to keep growing and thriving, so they usually don't pay dividends. It's like they're keeping their eyes on the prize of future success. If you enjoyed this explainer and want to see more videos breaking down investing concepts, please like, subscribe, and leave a comment below with topics you want covered.